It was taken up with a lot of community support by FASB. After a very thoughtful process, they came to the conclusion unanimously that they should give Bitcoin fair value accounting treatment rather than indefinite intangible accounting treatment. The latest communication on that indicated that they'll make this mandatory for all public reporting companies as of December 15th of next year.
In a recent interview with Michael Saylor, conducted by Nick Bacha, the renowned crypto expert elaborated on the implications for operating companies considering adopting Bitcoin as a financial metric. He also discussed the progress made by companies already incorporating Bitcoin into their financial strategies. Saylor outlined his rationale for favoring Bitcoin over traditional sovereign debt in the realm of corporate finance. He shed light on the long-standing criticism Bitcoin has faced due to its unconventional nature, prior to the implementation of a new policy. Saylor believed that the adoption of a new policy was becoming inevitable, given the growing interest of mainstream companies in Bitcoin. Recognizing the need for strong community support, a unanimous decision was reached to reclassify Bitcoin's accounting treatment from indefinite tangible to fair value accounting. This change is poised to become mandatory for all publicly reporting companies, with the possibility for others to opt in, allowing them to choose whether to incorporate Bitcoin as a cash metric. This development highlights the significance of Bitcoin's evolving role in financial systems, akin to managing a portfolio on a balance sheet. In the following clips from the interview, we'll delve further into these insights.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
The significance of fair value accounting coming to Bitcoin is it makes the asset non-toxic for an operating company to hold or a company that uses GAAP accounting. It also makes it transparent, the performance of Bitcoin-backed companies to be transparent. And so that's a positive feedback loop, right? When Bitcoin companies are performing well, it'll be obvious to Wall Street and they'll want to finance more of them, right? So that's a secondary benefit. And the third is because Bitcoin is a commodity, it's a financial commodity, it can be held on the balance sheet of an operating company where right now only treasury assets or sovereign debt type assets can be held on that balance sheet as a treasury strategy. Now, if you think about your treasury strategy, the treasury strategy of an operating company is we want something which is liquid and fungible and low risk. So traditionally, the most liquid, fungible, low risk financial asset is just the dollar, the local currency, maybe the euro, maybe the dollar. And so that's the obvious thing to do. I collected $100 million this month. I put it in the bank. Now, the problem with that is that the dollar doesn't generate a yield. And the dollar is a depreciating, debasing financial asset. So in a world where the dollar gets inflated 7% a year, if the money supply of U.S. currency increases 7% a year, and it has over the past 100 years, then $1 billion in cash is going to cost you $70 million a year in purchasing power. And of course, at 7% a year, over the course of 10 years, you'll cut your asset value in half. So it doesn't take a rocket scientist to figure out that a treasury strategy based just on currency isn't awesome. It's dilutive. The question here is, what's the next best thing? Well, the next best thing is sovereign debt. Sovereign debt is debt issued by a government. So you've got the most creditworthy counterparty, maybe the United States government. You don't really think they're going to default. And that's the advantage of sovereign debt. You might take on duration risk. If you buy long-term bonds when the interest rates are low and interest rates go up, then the bond will trade down and you could get wiped out that way. That happened to a bunch of banks about a year ago. Silicon Valley Bank and the like. They bought long-dated credit instruments and interest rates jumped from 0 to 500 basis points.
A week prior to the interview, MicroStrategy's executive chairman, Michael Saylor, shared an update on X, previously known as Twitter, in which he informed the public and crypto enthusiasts about the Financial Accounting Standards Board decision. FASB had recently granted permission for companies to utilize fair value accounting principles when reporting their cryptocurrency holdings on their balance sheets. Saylor expressed his enthusiasm during the interview, underscoring the significance of fair value accounting, as it removes the toxic label from assets held by operating companies. He emphasized that this development is crucial because it brings transparency to Bitcoin's performance, aligning with the interests of Wall Street and financial institutions. Saylor further noted that since Bitcoin is considered a financial commodity, it can find a place on an operating company's balance sheet, much like treasury assets or sovereign debt. Operating companies are permitted by regulators to hold substantial property compared to traditional securities. Saylor held the belief that companies are likely to favor Bitcoin over other assets, such as sovereign debt or the US dollar. This preference is rooted in the fact that the latter, being a traditional asset, does not yield significant returns, making it a depreciating financial asset.
The problem with commodities is there's a dysfunctional, systemic, endemic inflation built into the system. Not only is it possible for someone to create more oil, it is a certain thing that when the price of oil triples, they will create a lot more oil, and no one is concerned about keeping the supply of oil in check over the long term. There's this dysfunctional competition. You can try to create a cartel like OPEC, but people that aren't in the OPEC, like the frackers in Texas, they're not in OPEC, and they're going to frack oil, and they're going to bust that cartel. And all of these commodities find their cartels broken, and the gold miners want to produce more gold, the silver people want to produce more silver, soybeans want to produce more soybeans. So commodities aren't scarce. And I want to distinguish between that kind of ungoverned inflation or dysfunctional inflation versus the governed inflation of equities. You know, Apple Computer or any company in the S&P 500 can also issue more stock. And if you buy infinite amounts of the S&P index, you'll get a lot more stocks. They will issue more stocks. During the height of the market boom in 2021, when you had GameStop and you had all the meme stocks, you saw all these people printing a lot of equity and selling it to the market. And that's the danger of those assets. But at the end of the day, Tim Cook doesn't want to print infinite Apple stock. I mean, Tim Cook understands, and his board of directors understand, that if they want to maintain the credibility of the corporation, they have to maintain some control over the amount of shares they issue. And the same is true at Microsoft, and the same is true at Google. They may print more equity, but it won't be ungoverned and dysfunctional. But imagine there were 100 companies called Apple, and they could all print Apple stock. And people want Apple stock. So maybe Tim Cook wouldn't, but the Apple competitor number 4 in Timbuktu, they could, and they could sell Apple stock. Well, in that case, they're all going to print as much as they can to drive the price down because they're ungoverned. And in fact, they have an incentive to sell the stock. And so that's what it's like in the commodities business. Somebody somewhere has an incentive to drive the price of that commodity down, and they will sell as much as they can get their hands on. And so that being the case, there's never been a commodity like Bitcoin that was scarce. The closest thing to something like Bitcoin would be acreage in Palm Beach or acreage in Miami Beach. Not the square footage, but rather the underlying dirt. Because there's only so many linear feet of beachfront property in Palm Beach for the last 100 years, and no amount of money printing, and no amount of capital, and no amount of technology, and no amount of manufacturing know-how creates more beachfront property in Palm Beach. So when you look at that scarce, desirable property that you can't create more of, you can see that actually does go up in value. That's gone up by a factor of 1,000 in the last 100 years, 1,000x. And that appreciates at the rate that the money expands. But the problem is, it's not a treasury asset. I can't buy and sell square feet of Palm Beach every day in the market. I can't liquidate it on demand. So the kind of property that I would want to hold, I can't hold as the CFO of a publicly traded company. The kind of stuff I can hold, sovereign debt, it isn't scarce, and it's a currency derivative. And so Bitcoin is this new thing. It is a digital scarcity that's liquid, that's fungible, that gets commodity treatment, that I can hold on a balance sheet as a treasury asset. And while the currency is not generating a yield and the bonds aren't trading up in asset value and they're generating taxable yield and with a negative real yield, Bitcoin will appreciate in price tax deferred.
During his interview with Nick Bakia, Saylor highlighted the exceptional nature of Bitcoin as a commodity. He stressed that unlike every other existing commodity, which is subject to inherent inflation, whether governed or not, Bitcoin stands out due to its decentralized nature. He drew a clear distinction between governed and ungoverned inflation but noted that both could disrupt the prices of commodities. Bitcoin's uniqueness lies in its decentralized structure, preventing any single individual from monopolizing its price. It is a one-of-a-kind commodity that can be bought, sold, and liquidated at any time. Saylor further likened Bitcoin to a treasure in a desert oasis, whereas the oasis represents a scarce, desirable property that cannot be manufactured, regardless of the expertise, technology, or capital invested. This comparison highlights Bitcoin's advantage over other alternatives in corporate finance. Unlike the oasis, Bitcoin is a treasury asset, and Saylor described it as a digital rarity that is both liquid and fungible while still being treated as a commodity. What are your thoughts on Michael Saylor's perspective regarding Bitcoin in the context of corporate finance? Do you agree with his positive outlook on the potential changes that could come with the policy shift by the Financial Accounting Standards Board? Feel free to share your comments and opinions in the comment section below. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.